Thank you, by the way, for having us and being able to present to your clients here. We're going to go through navigating the real estate market and kind of go a little deeper into alternative investments. Um, some of the return difference you can do from just placing your funds in a traditional IRA account versus, taking those funds and using them on alternative investments can be a huge difference in those returns. And just a little bit more about us. I know we kind of already talked about Elevate, but as far as the team, in the last 7 or 8 years, we've assembled a really strong team. We're vertically integrated, so we've got the real estate firm, which is Elevate, and then we also have a construction arm and a property management arm. That gives us a lot of flexibility. It helps with the cost, and it just really makes for a strong team that can perform on our business plans on these deals. You've got myself, I am co-founder and CEO. Eric, who is also a co-founder and COO. You got Brian, who's on here today with us. He's our CIO. Um, Nick Bowden, a senior analyst. We got Joel, who's in charge of asset management. Mina, who, if you're one of our investors, you probably know him, but he's investor relations. And then we've got Tessa and Mike, who run the property management side. We've got several others in the construction side. So a lot of key personnel that has helped build the portfolio that we have. Like I mentioned, we've got roughly 650 million in assets under management. We've acquired over 7,000 units, exited a little bit over 1,800 of those. We've returned average IRR to our investors in those 1,800 plus units at a 47.7% return. Um, I mentioned the vertically integrated. So as you can see there, Elevate is the real estate firm, and then we got J&T Construction and Equity Real Estate Management. Like I mentioned, it really helps with having that consistency across all functions of this business. We learned early on that, you know, the less we can count on third party companies, the better we can perform, and it's really been helpful to our success. Brian, I don't know if you have anything to add. Just feel free to jump in at any point.
Yeah, for sure. I think this part we're going to go into asset classes today, and talk about what we're looking at navigating the real estate market. Before you even get into a market or underwriting on a deal or what kind of financing you're going to set up or what the structure is to the investor, you want to make sure that the sponsor or whoever is going to be operating the deal has this kind of experience in vertical integration, and that definitely does not come overnight. That was one of the reasons why I partnered up with Elevate in the first place, was that experience, to go through any kind of market cycle. So super important when you're choosing an investment, and is who you're choosing your sponsor to be.
Yep. So like I mentioned, we're gonna go over asset classes in general, right? So I mentioned your typical investments are your stocks, your bonds, your mutual funds. Those are the things that were kind of brought to our attention as we um, are in school and just maybe even in business, right? But alternative investments is something that's really not mentioned as much or taught as much, right? And that's really where we're going to dive a little deeper into the alternative investments, especially real estate. So yeah, so why real estate, right? Why we chose real estate and why we think that's the smartest investment in our opinion. When you're investing in real estate, you're investing in an asset that's hopefully producing cash flow or will produce cash flow depending on the business plan and the value add of it. Um, the leverage on these deals is very, very favorable terms, which then allows for our investors and the equity to get solid returns on their money. You know, when we're paying, say, 5.5% interest on our debt, that really allows for more cash flow and to be able to pay out our investors good returns. You also get equity in this asset, right? When you invest um, as an LP, you get the benefits of not just the property appreciating over time. And I'm sure we all know that real estate over time appreciates, right? As you maybe not year over year, but depending on where you are in the market cycle, I mean, it's a constant going up when you look at real estate. Um, the best thing about multifamily real estate, which we'll dive a little deeper into, is the fact that you can force the appreciation as well. So you don't just have to sit and wait for the market to appreciate. We can add value, and essentially, the more income we create, net operating income, the more that property is going to be valued. And then on top of that, there's some great tax benefits. You know, I know some of that is restricted or all of it if you're investing within your IRA. Um, but it is there if you could take advantage of it. And then the fundamentals overall. So especially when it comes to multifamily, you know, owning a home has become tougher and tougher. It's not as affordable as it used to be, right? Especially right now with the rates a little bit higher. And that's really driving a lot more individuals to have to go and rent. So, you know, we feel that multifamily is a great space to be in. We're still, um, the supply is not quite there for the demand. Even there's been some oversupply in some certain markets, but that's getting ready to pretty much die down because nobody else is building, or they're not building as much as they were maybe a year ago, 2 years ago, now that the market's slower. So there's definitely a supply issue, which also drives a lot of demand. And sorry, I'm going to start going a little bit faster because I do want to make sure we get to your questions. So as far as within real estate, within itself, there's a lot of different asset classes as well. So you've got your residential properties, which, you know, it's your single family. You've got your multifamily units, condominiums, townhouses. And then you've got your commercial properties, which could be your office buildings, retail, hotels, warehouses, self-storage. And within each of those, you've got even more. You can break it down even further. We're going to focus, yeah, so this is kind of breaking it down a little further within each one. I'm not going to go into too much detail there. Um, you know, you can also consider land, right? So just having raw land and adding value to that um, as well. And then, yeah, so as far as what we're going to cover now in a little more depth is what we feel are, you know, the top four real estate asset classes. So multifamily being one. That's obviously the space that we play in, and we feel very strongly on the fundamentals there. But on top of that, you've also got storage, industrial, and retail. So as far as I'm going to leave multifamily for last, but going into industrial, we've had a ton of where. Sorry, give me 1 second. Actually, Brian, you want to take over?
Yeah, for sure. And I think that there is a million different ways to make money in real estate. So that is, a good sign for real estate, but one of the problems too, it can be overwhelming for a lot of people deciding what kind of asset class to dive into. I think it's important to choose one, maybe two different asset classes, and that's what we've done here. And something, of those different asset classes, the four that we've identified that have performed well, what we're looking for is performed well during past recessions, have a good mix of cash flow, have a good mix of forced value appreciation. So really protecting your downside. Industrial here can be still affected by different kinds of market swings. So, you have e-commerce booms and busts where that directly affects industrial. When people are spending less money, when we're in more of a recession, that can impact your industrial warehousing space where people just aren't necessarily buying more products and filling these places out. So next we have is retail. Again, this one, retail, it definitely got hit hard during COVID, where retail got hit hard, office space. So you notice we didn't have office space as our top four, but people still make money in office, but they've also lost quite a bit of money this past, since COVID and then the after effects of COVID. You are still seeing a movement of people going back into the office, but still it will never be the same. So much virtual capacity has changed that game. But retail, we're seeing a lot of influx back to retail. This is also very market dependent. Retail in Dallas, Texas, Northwest Arkansas, Kansas City, some of our target markets that we look at for multifamily, retail is generally doing well there. Where if on the opposite side, growth, non-growth markets where you have employers leaving, um, population, net population loss, you're seeing retail have an effect there. So retail is very, very market specific. So it's something you want to look out for there. Retail is good when you have more tenants. It's good, relying on one single retail tenant can be complicated and get you in trouble, but that's definitely something to consider when looking at retail.
Yeah,
Some
I
of
think that
the
one's a little, sorry, just a little more to add there. I think COVID really shake things up with retail. I think it all depends on your tenants when you have the retail and how strong they are. And even then, I mean, we've seen some large anchor tenants go down and have to file bankruptcy and closing stores all around. So I mean, it's definitely got some risk. I would say maybe one of the benefits is, having a triple net and not really having to, as far as an operator, the expense of it can be less demanding for sure.
Yep. Storage next, another solid one. Storage has performed well during recessions. You would think it would have a inverse correlate, less people have less money to buy things and store things, but renters still want, maybe they're downsizing or moving and they have a need there. The problem with storage is it is very easy to build. The barrier to entry there is very low, so you always have the risk of someone else finding a cheap piece of land and building more storage units there. So I think that would be higher on the risk for the storage.
Yeah, I think
But
sorry, one other thing there is the value add component of storage too. It's not you can only raise rents so much, right? When on these storage units. So it's a little harder to force that appreciation, at least compared to multifamily.
yep, exactly. That's another good point. And brings us to our favorite asset class and what we focus on exclusively at Elevate CIG, and that's multifamily. We've dove in and been exclusively focused on multifamily for the past 7 years. George mentioned background in other different asset classes, myself as well. So I talked about, so for multifamily, we like it because it has cash flow, it has forced appreciation, it has market appreciation. Your tenants are um, paying your expenses and tax benefits. The tax benefits are really good for multifamily. Um, so those are the main reasons why we like it. We like the control aspect of it, that we can come in. There's a lot of economies of scale with multifamily. You're getting the benefits of residential rental real estate. Everyone is always going to need a place to live. And you're getting the economies of scale of commercial real estate where you're able to bring in that property manager and manage it better than the person before. And ultimately, you're running it like a business. So, those are, the big reasons that we like multifamily, and why we've been able to perform well, in the space.
Yeah, I mean, a couple things there, kind of looking back at the different assets we just covered, right? The different asset classes. Um, the reason we like multifamily so much is, once again, the fundamentals, right? If you compare, somebody's always going to have a roof over their head, right? You got to live somewhere. When it comes to storage, you don't necessarily have to store stuff, right? You can just get rid of it. Um, you don't necessarily need to go buy things at a retail store. You don't necessarily need to go buy more packages and more stuff, where you would then need the warehouse. And so, I mean, to me, it comes down to, it's the most, I want to say, recession proof. It's been resilient. You know, when COVID first came out, I think multifamily definitely showed how recession proof it is, where it was still holding strong. You know, right now with the real estate market kind of in a down, right? It's still showing how resilient it is. And some of the numbers, like I was mentioning, there's been a ton of construction, a ton of multifamily apartments the past couple years because of how hot the market was. So now, and this is kind of, you see this in every real estate cycle. You know, now we're going to have a couple years where there's not going to be that many units delivered. And what that's going to do is it's going to drive up rent. It's going to drive up the value of the properties, the demand to own more of these properties. So we really feel it's a great opportunity right now to buy more of these multifamily properties. Back in 2008, 2009, when I was in real estate, you know, we tried to scoop up as many properties as we could back then. We didn't syndicate, and we didn't raise money from investors, so we're only able to purchase so many properties. But all those that we did went up in price dramatically as the market started going back up. And in our opinion, you know, we're going to see the same thing in the next couple years. Any properties that we purchase as the market comes back up, um, we're going to do really well with those. Quick case study. So here's a deal that we did so we acquired this back in 2021, 104 units in Augusta, Georgia. It This property pretty much hadn't been touched since it was built, um, in, I believe it was 70s build. So they hadn't really done much to the property. The owner had owned it for, I want to say, almost 20 years. So they were doing well with it, right? They didn't have to do all these upgrades and whatnot. So we went in, we bought it for 50,000 per unit. We had a business plan to come in and rebrand it, completely fix the exteriors, and then upgrade 25% of the units. The reason, you know, we saw this as we were coming in at a really low cost basis, and we were going to just do a portion of the units and then put it back on the market and sell it, as a case study, kind of for the next buyer to come in and do the rest of the units. So we had a budget of 1 million for capex for renovations, and we quickly got in. Like I mentioned, with the vertical integration, we are able to control and move quickly. So within 6 months, we had completely changed the property, as you can see in these pictures. We took care of several of the roofs. We painted all the brick and woodwork. We replaced some of the fascia and siding. We took care of some of the stuff you can't see, right? Like the AC units, some plumbing leaks. We really hardened the property. Um, we came in and did those units, those 20 something units. We upgraded them. We got a substantial amount of rent bumps on those units, and then we just managed it better as well. So we were able to put it on the market literally 1 year later and sold it for 104,000 per unit. We were able to deliver more than a 2x. I think it was a 2.14 equity multiple to our investors within 1 year. Um, the fact that the market was on fire obviously helped us with some of those returns. So I'm not saying that this is expected every time we have an investment to double our investors' money in 1 year, but just wanted to give you guys an example of what a deal looks like. And then this is another sample of what a investment offering looks like. This is a deal that we are currently in the middle of acquiring. It's in Burleson, Texas. So we're projected to hold it for 5 years. Projected IRR of 16 to 18% with a cash on cash of close to 10% and an equity multiple of 2 to 2.1x. The reason there's kind of a range on those projected returns is we've got different class shares. So we got three different class shares. Depending on how much someone invests, from $100,000 minimum to $1 million minimum are the different class shares. But if you guys are interested in looking at more of these offerings, you can go right here to our website and just sign up, and you'll see some of that.
George,
Yeah,
somebody just asks, looking on Investors Row, I see that there's a minimum investment of 50,000. Is this just because it's a new deal that you're offering? Do you have multiple deals? Is this just the newest one?
yeah, got it. So this is a specific deal, so not part of our fund. On
Oh,
these, we usually do 100,000, and if somebody doesn't want to do the 100,000 and they've got maybe less to invest, we'll have that conversation. We're able to take less on the minimum. And
so
then as far as the fund,
yeah, thank you, George. That was my next question. I want you to explain to IRA Club clients that are listening, because I have a feeling that just drew some sort of confusion. Why
yeah,
don't you explain the difference between, again, a fund and the investment that you
right,
sorry, showed the entire audience, and what are the differences between the two?
for sure. So let me go back here. So this is a deal specific. We're raising equity for this exact deal, raising 6.8 million for this deal. And if somebody comes in and invest here, they're investing just to Camden Crossings, right? What we've done late last year, we decided to put out a fund where you're investing in the fund, and then that fund is going and investing in different deals so that it's spread out between more than just one deal. I don't want to say one is better than the other. It's more of on this one, you're projected to get some pretty solid returns. It's more of an equity play versus the fund is more cash on cash. It's you get distributions on a monthly basis. We've been hitting our preferred return every month on that fund. Versus on a deal specific one, usually we're paying out distributions quarterly, depending on, if it's a large value add, we may not pay out for maybe 6 months, 9 months, depending on what that is. Versus the fund, literally month one, you're getting that distribution. Um, you're also on the fund, you're capped on how much your return is, versus on this deal specific, it's not capped. It's just depending on how the deal does.
So, George, if you don't mind, what are the like? So when people, I just want our clients, because I'm trying to educate them. What are the positives and what are the negatives? So if you were to say, if you were to invest straight into this deal, what is the positive and what would you say some of the negatives are?
For sure, for sure. And we have a lot of investors that will kind of split it too, right? They'll put some
Yeah.
in one of our deals directly and then one in the fund. Basically, if you're looking for cash flow, and that's your main concern here, then I think the fund is a great tool for that. If you're looking at more of, hey, I want to grow my investment as much as I can, then a deal specific like Camden Crossing would probably be a better option. You're not going to get as much cash flow, but the possibility of you growing that investment larger, um, it would be better in a deal like this.
So Jeff actually just asked me, um, is there leverage against Camden Crossing? And if so, isn't that going to trigger UBIT? If utilizing retirement dollars, I'm assuming that's what you're saying, Jeff. Is there leverage against this, George?
There
And
will be a
correct-
senior loan. Yes.
Yes, there is. Okay. So George, you are right because I know who you are and I'm sorry, not George, Jeff, that you understand UBIT or UDFI, which is referred to, ladies and gentlemen, that are IRA Club clients or non-IRA Club clients, unrelated debt financed income. Yes, you will trigger when utilizing your retirement dollars, UBIT tax. We could go into that in a split second and where to find that and how you understand UBIT. I'll show you where to find that on our IRA Club website. However, if you're investing with your IRA dollars within the fund, and correct me if I'm wrong, George and Brian, this is a 506C, correct me if I'm wrong, the fund.
Correct.
Okay. So with that being said, you will not trigger UBIT because you are investing directly into the fund and the fund is dispersing the dollars amongst multi different types of asset classes. Correct me if I'm wrong again, George. The fund
No, that's
itself is
correct.
awesome. So with that being said, that is a way to not trigger UBIT for those of you that are listening. Another way that you could offset UBIT, because this question does come up every once in a while, is partnering. Okay, you could partner or buy out an asset outright. That's another way that you would not trigger UBIT. Or remember, this is not just about utilizing retirement dollars, because I know that's all IRA Club deals with. It's also about diversifying your personal dollars. Okay, I'm just looking at it at both sides of the fence over here. So if an actual fund, for instance, if you're worried about triggering UBIT within your IRA, which you will obviously do so within this investment opportunity, maybe use personal dollars. And then to utilize retirement dollars, you may want to consider doing the funds and the 506C instead. Hope that made sense to a couple of you that just asked that question.
Yeah, and we have a ton of investors that do both, right? And they invest from their IRA dollars. I'm not sure how much that tax is, right? But I feel like a lot of them feel that it offsets the amount of returns you're going to get, kind of offsets that.
Yeah.
But
Oh, George, trust me. A lot of people are. I always tell our clients, is the juice worth the squeeze? Meaning, is the UBIT tax worth it if you're making X, Y, and Z dollars? So where you're not going to make that. And again, I don't tell people what's right and or wrong. At the end of the day, we're trying to tell them these are your options. This is what you could do. This is how to avoid this. This is how to do that. And ultimately, as a self-directed IRA company, you get the ultimate say so because I'm trying to take the control away from them, meaning the Fidelities, Vanguards, and Schwabs of the world, and giving it to you guys, our clients. And that's it at the end of the day. You pick and choose what you guys want to do. Oh, you're talking about Investors Road, George? I'm going to steal you to the punch on this one, buddy. I don't mean to take.
yeah, I was about to say you're going to go through it
I'm going to break
anyhow.
this down for you IRA Club clients, where to find you guys, how to do due diligence, and we'll go from there. But yeah, thank you for including that, by the way. But
No problem. And then that's pretty much it. We would love to take some questions. You
Mhm.
can find more information about us on our website. You can sign up for our newsletters. And there's a ton of educational content on there as well.
Well, I'm going to exit out of here real quickly. And what I'm going to do, like you just said, you would like, here is Elevate's website. I'm going to copy and paste this into the chat. Feel free. Again, that's what I want you guys to all be doing. And as I'm going through Investors Row, get your questions ready to go. There's a couple more that popped inside the chat. So one person actually, George, maybe you could answer this while I'm going. What makes you different than any other syndicator?
That's a great question. So before I started Elevate, I was an investor. I decided to grab a chunk of my funds and put it with different syndicators in multifamily syndications. And I did it for two reasons, right? One, I was sold on the benefits and I wanted to see it firsthand. And two, I wanted to see how they treated their investors, their clients, right? And I was somewhat amazed on how the communication lacked. Meaning I would invest whatever dollars, 50,000, 100,000, whatever it was, and I wouldn't hear from them for months on end. So I know one thing, I wanted to change that with our company. So our communication, I want to say, is definitely on point. You're always going to receive our monthly updates that are very detailed and let you know what's going on. We usually do a investor property tour where once we've created some value at the property, once we've done some renovations, we invite our investors to come out and take a look and see, what their money has actually done at the asset. We do videos on the asset as we're doing things. So I want to say we're different with our communication. I think the track record part speaks for itself, but what really makes us different is the way we communicate with our investors.
And I'm sure you have like monthly or bi-monthly like meetings or quarterly meetings with your investors.
Absolutely.
Absolutely. So for those of you, I kind of went ahead, and Eva just asked the question in the chat. Says, is this for accredited investors only? I am non-accredited. I'm assuming the answer to that question, because I just saw it, was accredited investors only. Yes,
The
George?
the ones we've specifically talked about, yes. We do have deals that come out where we offer it to non-accredited investors. So I would suggest you go on our website and make sure you sign up, and you'll get that information as deals come out. And we can also schedule an appointment with us, so we can get a better feel for what your investment goals are, and we can kind of help you through that.
Okay, so again, I know a lot of you are mad at me. Recently, I've had a couple people via email me and say, "Hey, Ramez, I'm a non-accredited investor. I'm a non-accredited investor." Sometimes, like, you think, what is the point of watching these webinars? The goal one day is to get you to that status. Although I think, excuse my French, it's a BS rule. Like, who constitutes someone from becoming an accredited investor versus non-accredited? And I know George is smiling at that, because I think there's some very savvy non-accredited investors that are out there. Again, the
Agreed.
goal is to get you there, right? Not think, like, thinking outside the box is what I want you to do ultimately. But George and Brian just both basically just told you there are opportunities where we do allow non-accredited investors to jump on our deals. However, you have to reach out and maybe just get put on a waiting list. And if once that pops up and they just reach out via email and say, here's something that's available, again, your job is to do the due diligence. The webinar that we're currently doing, someone just asked about, is this recording going to be available? Yes, every single person will receive a follow-up email with Brian's contact information, but you could also check out this webinar right over here. Just give us a couple of days for us to edit the webinar. Here's a little bit more details about Elevate, direct access to Brian. Please communicate with each other. That's the whole reasons why I do these webinars. And network. Okay. The fund itself, I just kind of went through that as George was speaking. It's right over here. Investment details. You did say 50,000, 8% targeted rate of return. Accredited only. These are their distributions. I could have sworn you said, George, there were distributions. Yes or no?
For
Monthly,
the fund,
monthly
it's monthly
distributions.
distributions, yes.
It's monthly. Okay, we need to put that in there so people know that it is monthly distributions. So that's always good. And then again, do your due diligence. Make sure they're filed with the SEC. I like to go to the EGDR SEC website before I jump into anybody. I mean, just little basic things like that. But talking to each other, ultimately a video. And if you are interested, I will tell you from right now, George, Brian, their entire team, Mina, even if you don't want to go through this pledge to the investment bond, they will literally pre-fill out the subscription agreement for you with your retirement account numbers, all of it titled the right way, and they will send it directly over to Carlos and the investments team. Okay, they actually will do the work for you. Where this is what, George, I appreciate what you said, most syndicators or individuals that are in the multifamily space, they will not do that at all. George's team does. They will do that part or that portion for you, which I, again, greatly appreciate.
If you're not investing in alternative investments, definitely take a look, get educated on it. Um, it can just make a world of a difference if you're able to find a strong operator and put some funds in those alternative investments compared to just letting it sit in stocks or mutual funds or whatever it is.
Thank you as always, and we will touch
Thank
base. Take care, guys.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.